In a recent interest.co.nz article, ASB economist says that New Zealand's current high level of construction is not sustainable unless we see a sharp rise in the net migration in the next couple of years. What's going on, everybody? It's Blandon here again for Mortgage HQ. This is the final part of the three-part series on the three major influence on the property market. Let's do a quick recap of the first two. Now, when it comes to the short-term demand, we have to look at the monetary policies, which refers to interest rates and the money supply, and these two are going to influence how much people want to buy properties. Medium term, we're going to look at the housing supply. This is paying attention to the level of construction activities, the level of consents to build, the government spending on infrastructure, and potential planning initiatives. The third one, which we're going to explore in this video, is going to be relating to the population and economic growth. And we're going to break this down into three parts as well: inflation, income growth, and net migration. So inflation. There is a high correlation between inflation and house prices. In fact, there are correlations between inflation and any goods and services that have a limited supply. To give you guys a very simple illustration, consider an economy has a money supply of just $10, and there are 5 identical houses. Each house would be then priced at $2, and we're going to assume there are no other things that you can buy in this economy. So 5 houses, $2 each, there's only $10 in the economy. Now suppose that the central bank decides they want to print more money and they're going to expand the money supply from $10 to $20. The first person that is willing to pay more for those houses are going to get it, effectively increasing the price to $4. And potentially if there was one person that has more than another, they might pay $5. In this simplistic example, increasing the money supply is increasing the inflation rate, which will cause house prices to increase. That's exactly what's happening to our economy. Now, of course, in the real economy, there are a lot more other factors that's going to affect house prices, and the effect is not going to be as prominent as our simple example. Now, you guys already know the other major factor is interest rates. Lower interest rate is going to cause the demand to spike up for houses, therefore increasing the prices because it has become more affordable. Now, of course, if the supply sort of remains the same and demand increases, that will also cause the prices to go up. In larger cities where land is often limited, you can see a pronounced effect of this inflation and prices. Secondly, we got income growth. Prices go up, we hope that your income will go up as well. When we look at income growth, we need to learn about GDP, or gross domestic product. Simply put, this is a measure of the productivity of an economy. How productive are you guys as a whole? For residential real estate, you can say that there's a high correlation between GDP growth and the real estate capital gains. In simple terms, the more you work, the more you earn, and because you have more money, the higher chance that you would want to buy a place for yourself to live in. Income, in turn, can be directly derived from GDP from a few adjustments. Studies in Asia, Europe, and the US review that the median house price correlate by as much as 60 to 95% with the GDP per capita, which is basically measuring the productivity of each individual in the economy as an average. However, it is worth noting that the prevalent real estate cycle do not always mirror GDP growth, but often follows their own pattern and a bit of delay in between the data. In short to medium term, the property market dynamics are not just driven by the country's prosperity, and of course depend on many determinants. These are, for example, urbanization rate, construction activity, and demographic changes, which all will influence the supply and demand temporarily. In summary, things can get a lot more complex if you want, but we can say that the GDP and the income growth is a leading indicator for the future property market growth. So on to the third one, we got net migration. And if we were to simplify this, more people move into the country, more houses are required. And because of the lack of land and infrastructure, this will automatically drive house prices up. Now, according to Stats New Zealand, net migration actually saw the largest drop on an annual basis in 2021. Net migration dropped to just 6,600 in the year end March 2021, compared to a whopping 91,900 last year. It is worth noting that the net migration last year was the highest that we have ever seen. This was a lot of people just wanting to move back as soon as they heard about COVID. Now we can attribute the fall in net migration to the border restrictions. And on an annual basis, this is the lowest that we have ever seen since 1986 and the lowest migrant departures since 1969. Now with all that info, what does it all mean? So a quick summary, economic progress plays a major part in the real estate market. If you have a thriving economy and a good country that you can raise families, this will always attract more people in the long run. Now, although we're facing some of the lowest migration numbers we have ever seen, I do believe migrating to New Zealand, it's a luxury product for many people outside of New Zealand. Meaning as soon as it's available, it will resume and people will keep moving in. So I really think as soon as the borders open, we're going to see net migration spiking up again. With that in mind, I still think long-term prospect for property is still very strong. The immediate risk with property will obviously be the cash flow because interest rate is going to be going up. And this is something you will need to manage very well moving forward if you're looking at investing in properties. And so there you have it, folks. If you guys have found value, please smash the like button for the YouTube algorithm. And until next time, I'll see you guys in the next video.